Some investors are looking at the ongoing banking crisis and they're worried, could this lead to potential hyperinflation? One investor who does think so is Balaji Srinivasan, who's willing to put his money where his mouth is. He's making a $1 million bet that you could see hyperinflation in the US within 90 days. Now, his former background included being the chief technology officer of Coinbase, as well as former general partner at Andreessen Horowitz, a very successful venture capital firm. So he thinks hyperinflation within 90 days and potentially that Bitcoin goes to $1 million within 90 days. Not only hyperinflation, but hyper Bitcoinization. He's quick to call out Ray Dalio. He says Ray Dalio predicted the Fed would monetize the debt, but not how or when. Balaji's saying, look, now is the time. Calling out specifically what Ray Dalio said. And keep in mind, Ray Dalio is one of the most successful hedge fund managers of all time. Big devaluations are abrupt and episodic rather than evolutionary. So this isn't going to just slowly progress. This could happen in a very short time period. Now you might be wondering, well, okay, so who is this guy? Like, yeah, I called out the Coinbase and Andreessen Horowitz. Like, is he just a complete nutter? Now, he does have supposedly a net worth in the tens of millions of dollars because he did have a startup that was sold for several $100 million. At least that's what's reported. And he did call out well before most people saw it on Twitter in January 2020, warning folks about the coronavirus going viral, saying, hey, could this be the pandemic that public health people have been warning about, saying, look, it could accelerate many trends like border closure, nationalism, social isolation, remote work, face masks. These were all things that a lot of folks weren't anticipating, well into March. And so this is, you got to give him credit for this. This was a really good call in January 2020 before you start seeing the shutdowns, before you start seeing the real impact of COVID. And so he got that one right. And that was a very bold and sort of, remarkable call. Now, why is he calling for hyperinflation now? And do I think that's right? So part of his thesis is just looking at the banking sector, looking at to the tune of several $100 billion in losses. What ended up happening, super quick recap, and I've covered this in several videos on the banking crisis, is the Federal Reserve lowered interest rates to spur the economy, get things going in response to COVID, bring rates down to zero. A lot of these banks were flush with cash, wondering what do they do with it. So they put it, instead of keeping it in short-term treasuries yielding close to zero, they put it in longer dated bonds. And that was a big mistake, putting it in 10, 20, 30-year treasuries and mortgage-backed securities. As interest rates rise or went up because of inflation, the Federal Reserve saying, hey, we got to combat inflation, that bond portfolio dropped significantly in value. And so based on what the FDIC is saying, so what is the government saying? They're saying these banks have a hole in their balance sheet to the tune of $600 or $700 billion. That is a lot of money. And then it gets worse because Silicon Valley Bank, which was insolvent, I called it out in a video before they were seized. Within 24 hours, I said, grim prospects, unlikely to recover. And that because their balance sheet was insolvent and because depositors were pulling their funds. And now you're seeing studies that, yeah, this isn't the only cockroach in the kitchen. There might be 200 banks just like Silicon Valley Bank, now probably much smaller, that could have the same fate of where they might need to get seized. And so this is the concern of like, oh, this problem that you see with the balance sheets and with potentially getting seized, this could lead to even more maybe stimulus ahead. What do we see an uptick of inflation? And this gets worse when you say, okay, so there's this problem with all these banks, and how's the Federal Reserve going to solve it? Well, some people are looking at headlines saying they could end up injecting nearly $2 trillion tied to this new bank term funding program. And this funding program is to help these banks that have this hole on their balance sheet, this $600-700 billion hole. Sort of the Federal Reserve say, hey, we know you have these bonds that are now trading at a huge discount. We'll give you a loan against those bonds. Yeah, that bond might only trade at 70 cents on the dollar. We'll give you the equivalent of $1 for that discounted bond to help you through this crisis. And some folks say, wow, that could be a lot of stimulus. Could you see hyperinflation in response to this? And this is the chart that really gets the hyperinflationists, the Bitcoin maximalists really excited, is they see the Fed balance sheet uptick of $300 billion in the last week alone. And you could see, okay, this is the Fed balance sheet over the last few years, how you saw this huge uptick to the tune of several $1 trillion, from like 4 trillion to 7 trillion. So like $3 trillion in response to COVID. And then as the Federal Reserve was trying to squeeze liquidity out of the system in the last year, pulling it from $9 trillion to like 8.3. And then just in 1 week, you see the balance sheet reversing most of this quantitative tightening to the tune of $300 billion. Now, it's not exactly, printing money, because once again, it's loaning money, as this facility was about. And so, yes, their balance sheet expanded by $300 billion, but it's tied to actual collateral. It's not just, buying back, let's say, government bonds. But in response, you're seeing Bitcoin, rally significantly year to date, up nearly 70%, near $28,000 per Bitcoin. And so, will we have hyperinflation? What's going on here? First, in full disclosure, this is not financial advice. And if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. I also have some educational courses on how to read financial statements and how to value stocks that I recently launched. So one should understand the context of this bet that Balaji is making. Personally, I think it's just an awful bet. And I think this reflects that he truly believes in this outcome and he wants to warn investors, and he's not necessarily actually trying to make money from this. I suspect that he has probably the equivalent of tens of millions of dollars tied up in Bitcoin, and he thinks, look, this is a public service announcement. I think that's what he thinks, because one guy on Twitter said, look, I bet anyone $1 million that the U.S. does not enter hyperinflation. Then Balaji responded saying, look, I'll take that bet. You buy one Bitcoin, I will send $1 million US. He's effectively doing 40 to 1 odds, given that Bitcoin's only $26,000. And he's saying, look, 90 days. And this is just, honestly, it doesn't make any sense. He's not making money from this because he already has a ton of Bitcoin. He's really just trying to say, look, at least he's not making money from this unless he's able to cause sort of the marketing push that gets Bitcoin to go higher because of this. He caused enough, sort of fear, and therefore people take money out of the banking system and put it into Bitcoin. And because he has a lot of Bitcoin, then it's worth more. But I don't think that's his angle here. I think he's trying to say, look, he truly believes in this. I think he's this is his cause. Former chief technology officer of Coinbase, clearly believes in this. And he just wants people to survive what he thinks will be hyperinflation. So do I think we have hyperinflation? No, I don't think so at all. I'm always curious if someone has a smart opinion about something, or has a track record of intelligent bets and, calling out COVID and, making tens of millions of dollars for himself across various different bets previously, that does get my interest. But I do think his call on hyperinflation is 100% wrong, partly because of how the Federal Reserve is responding to the crisis. It's not like the Federal Reserve is saying, hey, here's an open wallet, let's just print trillions of dollars. Yes, you have JP Morgan suggesting that they could ultimately expand their balance sheet by $2 trillion. But it's quite different than, let's say, the US government running a debt, issuing treasuries, so issuing, treasury bonds, and then the Federal Reserve buying those bonds and effectively monetizing it. That's a sort of a two-step dance that results in, money printing to fund deficits. That's not what's going on here. And that money printing to fund deficits, that's when you have real hyperinflation. If you just start printing, if you start spending like crazy and you start printing to fund it, that is the recipe for hyperinflation. That is not what we have here. I don't think we see hyperinflation at all. I think you could see elevated inflation, but one should have an understanding of just basic, banking system, how the machine works. And that's why I always enjoy watching Ray Dalio's videos, because he's clearly gotten a lot from Ray Dalio, Balaji, but I think he's drawn some of the wrong lessons, which is that when you have the banking sector implode, like what you're seeing with several banks, it's actually a huge contraction in credit. And that certainly does not help the cause for inflation. And that's part of the reason why, Ray Dalio made the point that he knew that quantitative easing 1, quantitative easing 2, the very first quantitative easing from the, previously under Ben Bernanke, wouldn't lead to inflation, is because he saw that the hole in the balance sheet caused by all these banks blowing up with subprime was effectively this money that was getting printed was just sort of filling that hole. It wasn't excess money printing that was going on. And so what you're seeing now is the Federal Reserve doing something what I'd argue is quite cautious. They're not offering to print money. They're not offering to inject capital into the banks. What they're offering to do is provide 1-year loans, say, hey, get your act together, and we will use, it's a discounted bond, but you can use that as collateral. Now, these banks were already going to be in a tricky position because these bond portfolios sold off. So credit is going to be tightening. I don't see this as hyperinflationary at all. Now, what do I want to own in a situation where you could see continued inflation going forward? And I think over a multi-year period, I think that's what Ray Dalio was alluding to, is over the next decade, you could see higher inflation because of some secular effects, such as, the deglobalization, like where you're moving more of your production, nationally or close to, the country in which you want to consume the good. For example, instead of producing goods in China, you might produce them in Mexico, if you're in the US. And so, and that could be structural inflation. Another example of structural inflation could be a workforce imbalance, partly caused by COVID. We're still seeing very, very tight labor market. And so you're looking at these dynamics potentially leading to and also, look, I'm not saying the US government has a clean balance sheet. Like, there is some truth to what Balaji's talking about. I just don't think his time frame's right. I think 90 days is way too short. I think the US dollar will lose most of its value, but over a multi-decade perspective. And over that time period, when you factor in, let's say 3 to 5% annual inflation, you start asking yourself, well, what do I want to own in that situation? And even if there was, let's say, higher than 5% inflation going forward for, let's say, the next decade, then what would you want to own? What could you own? Well, first of all, gold is one thing that historically performed well in the 1970s. Personally, I'm not going that route. My view is I'd rather find the best companies I can around the world and say, hey, they're diversified. It's giving me coverage from beyond just one currency. Like, for example, as I called out to my subscribers at Unrivaled Investing, I've been recently buying a global insurance company. That's one of my largest holdings, trades at a really cheap multiple, global exposure. I look at this as, it's not just US dollar exposure. You get Europe, it trades at a low multiple. I think easily 100, 200% upside potential. That's at least, the things that I'm calling out. Another is an example of something that owns a bunch of, businesses in India that trades at, effectively 65 cents on the dollar. That's the type of thing where I'm going, okay, fast growing market, fast growing economy, not looking at the same sort of, balance sheet problems that the US is having. So this is potentially another way to diversify my bets. And that's what I'm looking at, these things that have a truly compelling valuation and does have structural growth in the years ahead. And could potentially, the businesses are such quality that even if there is, let's say, 3 to 5% inflation going forward, or even more, that they can pass on those costs to their consumers. And that's what you want to find. You want to find those quality businesses that aren't price takers, but that can easily pass through these higher input costs that result in higher earnings growth and higher revenue long-term. Because if you take a multi-decade perspective across various different, markets that have done well over time, not just the US, the key drivers are the fundamentals. So you want to find those businesses that can actually grow. And so I look at what Balaji's talking about Bitcoin, that he's thinking it could be a potential medium of exchange. It's way too volatile. It doesn't have something that I want to see, which is offering an unrivaled value proposition. That's what I want the businesses that I at least own. If you have an airport and it's a fast growing neighborhood and you're growing quickly and you have a multi-decade ownership of this airport, that gets me interested. When you're talking about effectively some speculative vehicle that's up 70% this year because people are like, oh, maybe there's hyperinflation, that just doesn't do it for me. I would rather look for quality assets that you can own over a multi-decade perspective. And that's at least my personal journey. If you disagree with it, I'd love to hear it in the comments below. And if this video has been helpful for you, please make a point of hitting that subscribe button. Thanks so much for watching Unrivaled Investing.